A study has found that the income of three vulnerable groups isn't catching up with their increased spending. They include gig workers, employees earning less than $2,500, and boomers aged 59 to 77. In its financial health report, DBS Bank says that they should watch their cash flow more carefully. However, the analysis revealed that the financial health of most Singaporeans largely remained stable. The study of its 1.2 million retail customers was conducted between May last year and May this year. Now, the bank found that boomers spent 86% of their income in the past year. Now, this is up from the previous year's 84%. Low-income workers spent 93% of the money that they earned. Now, compared with the median group, gig workers, they are spending more than they earn, dipping into their savings to spend. Now, this also explains why they have a smaller saving compared to other groups. Their cash can only last for less than 2 months, while the median group have enough money to last at least 3 months. Now, even though the median group is spending more, their wages are also rising. Their annual income went up some 7.2%. Now, this is higher than their expenses, which grew by 2.7%. When it came to investments, people are also steering towards those with lower risk, like Singapore savings bonds and T-bills. New homeowners, they are also feeling the pinch with those higher mortgage rates. The bank is cautioning those earning less than $5,000 to be more careful with big ticket purchases. Now, this group could be left with less than half of their income after paying for their monthly housing loan. The situation may be worse, with interest rates expected to remain high for the year.
Now, on interest rate, I think much really depends on the Fed's next action. We do expect, another one more Fed hike before the end of the year. And that would also implies that there could be some upside bias to our domestic interest rate, the SORA especially.
Well, we're joined by DBS economist Chua Han Ting. Mr. Chua, the report cites rising expenses as one reason why people are spending more. And of course, a part of that would be inflationary pressures. How long do you expect these pressures to persist?
Thanks for having me to share our latest financial health series at DBS. So I think certainly we have seen expenses rise and inflation is still quite elevated, although I think in 2023 there's ease off compared to the highs in 2022. But I think the key point here is that for the man on the street, the prices of goods and services are still rising, just that it's at a slower pace. So things are still getting more expensive, just at a slower rate. So in the second half of 2023, we are expecting some moderation in inflation, perhaps due to reduced imported price pressures. But ultimately, I think that inflation would still remain above the long-term average of 2% in Singapore. And with high inflation, I think what we have seen is a rise in interest rates. And this is essentially a double whammy situation. So in our study, we not only look at the impact of expenses, but we also look at income as well as financial stability, financial liabilities, and which segments of our customer base it would be caught in a rock and a hard place given these two dynamics of inflationary pressures and still elevated interest rates.
Yes, because there are fixed expenses that they just simply cannot avoid. They have to pay those mortgages. Mr. Chua, the findings also show that income grew almost 3 times faster than expenses on aggregate, but people between the ages of 59 to 77, the so-called boomers and low-income earners as well, they seem to have this worsening cash flow. What is this about?
So I think the median customer is actually their household's balance sheet is still quite healthy. Like you rightly pointed out, income growth was 3 times higher than that of expenses. But we identified low income and the boomers that are more vulnerable. So I think one key reason for that is that for these two groups, expenses have grew faster than income. So, but just to point out, for example, for the boomers, their expenses has grown above the median rate around 3.1, but that's still quite close to the median rate. But more importantly, if you think of boomers, right, just now you mentioned they're around age 59 to 77, they are essentially also can be considered the retirees or part-time workers, if you like, and therefore their income has grown much slower than compared to the rest of the generations. And I think for the low-income group, the expenses has also been higher than the median at around 4%, whereas their income growth has been much lesser. So that's a reason why the low-income groups are actually vulnerable. And in fact, I think beyond just these two groups, gig workers, something that we specifically highlighted in our report, is among the most financially stretched, whether across generations or across income groups. Gig workers really stand out. In the sense, I think you showed earlier our chart that we had in terms of expenses to income. Gig workers was at 112%, much higher than that of median customers of just 57%. So they are essentially spending beyond their means, and actually how they are doing that is to dip into their savings, which is below that of median customers, and in fact below the 3-month to 6 months range that our bank recommends for the median DBS customer.
Thanks so much for joining us with your analysis. It was Chua Han Ting, economist at DBS Bank.